engineering major Larsen Toubro reported a very strong set of numbers for the second quarter of fiscal FY24 yesterday on October 31st. Order inflow grew some 70%, strong net profit growth and revenue growth. The company also made an interesting announcement about making a foray into designing for semiconductor chips. Joining me today is Chief Financial Officer of Larsen Toubro, Mr. R Shankar Raman. Good morning, Mr. Raman, and welcome to Moneycontrol.
Thank you. Thank you.
Mr. Raman, as I was mentioning, very strong set of numbers from Larsen Toubro, and you have exceeded street expectations on most accounts. But help me understand, if I were to look at the half-year performance, it looks like, for example, on your order inflow guidance that you had given at the beginning of the year, you're already midway through, and the third and the fourth quarter are quite strong typically for L&T. So you did address media in a conference call yesterday, and you said you may exceed guidance. Are you putting a number on it, on what the guidance for order inflow and revenue growth would look like for the whole year this year?
See, it would be interesting to understand the dynamics of this order inflow for a projects company like us, because the quantum of investments that the project sponsors make determine the extent of participation that companies like us do. The first 6 months of the year saw significant order wins in the Middle East. Almost 2/3 of the order in the second quarter was from Middle East. And if I take the 6-month period, almost 55-56% of the orders came in from Middle East. And 90% of the orders from Middle East is from Saudi Arabia, the Kingdom of Saudi Arabia. Now, typically, these orders are very large and lumpy. Now, they are $2 billion orders, $3 billion orders, etc. So, the percentages actually become a challenge to deal with in terms of assessing in the context of the overall year as to where it will lead us to. For example, 70% growth in quarter two or 65% growth in order inflow for half year does not naturally translate to 130% growth at the end of the year, because the lumpiness of the orders may not really be seen in every project that we win. So these are outliers, but it is important win for us because it endorses the capability of the company. It enables the company to operate at a much higher league than what Indian opportunities provide us with. So to that extent, I think these are important wins. But having said that, up to 6-month period, the domestic orders have grown by 15%, in contrast to the international orders, which have grown by over 2.5 times. So our sense is that the domestic orders will start moving forward, because looking at the prospects of about 8.5 lakh crore that we have, almost 5 lakh crore is in the area of infrastructure alone. Of course, it remains to be seen as to what is the intensity, frequency with which these opportunities are put out as bids, tendered out, and selected and awarded. That's a process. But having said that, I think to expect such lumpy orders in Q3 and Q4, and hence, take the order inflow guidance for the year into a stratospheric level becomes a bit of a challenge. All that we are able to assess now is that, looking at the way we are positioned number-wise at the end of H1, it is very likely that we will outperform the 10 to 12% order inflow guidance that we have given for the year quite handsomely. So to that extent, while I don't want to speculate on a specific number, whether it is 15%, 17%, 18%, 20%, I do not know, because it all depends on the ordering momentum that we are going to see in the next 6 months. Typically, for domestic orders, the second half of the year is a little more robust than the first half of the year. And fortunately for us, the first half of the year got made up by the international orders. So the international orders prospect pipeline also looks pretty strong. It is not as though it is relatively weak. But the question is, I think we need to pick our spots now as we move towards closer part of the year. The resources that we deploy in Middle East is very different from the resources we deploy in India, etc. We need to do some right sizing and balancing of all of this. But we do think that we would be quite well ahead of the guidance.
So clearly, you're not going to give a number on this. The market is greedy, but well, we'll just assume that you are going to exceed the guidance. Just to be clear, you said the guidance remains at 10 to 12% for order inflow, and revenue growth guidance was at 12-15%. So you are retaining that, but expecting to exceed both.
Rachita, let me mention that the guidance is some kind of a goalpost that we set for
Right.
ourselves for the year as a whole. I don't think it's a good idea for us to keep shifting that goalpost, because I think we all as a company get confused as to what is it that we are chasing. So the goalpost remains the same. The point is to how much short or how much excess of the target that we are likely to land the year with. So our sense now is both in terms of order inflow as in terms of revenue, we are expected to outperform the guidance quite well by quite a margin, considering the place we are in H1 of the current year. But where exactly we will land up with, I think the developments of the next 6 months will put out.
Fair enough, Mr. Raman. Mr. Raman, I mentioned earlier that Larsen Toubro managed to kind of exceed street expectations on most account. The only dampener there was the margin bit. Again, something that you have been talking about on how there are pre-COVID legacy orders which are being executed at post-COVID raw material prices, and there's a significant impact that comes in. Help me understand, margin has declined from 11.4% to 11%. So for the rest of the year, where are the margins headed? And also in terms of the legacy orders, the pre-COVID orders, how much more is left on your order book where we could see a potential impact going ahead?
Uh, Let me try to simplify this for you. If I take a look at all our business margins, excluding services, because services operate at a different trajectory, so we should not cloud the margin of projects and manufacturing with services. When you speak about 11%, etc., you're speaking about the printed numbers on a consolidated basis. But the important part that we are addressing in terms of contracts which are bagged during COVID and cost post COVID, etc., is relating to our projects business. Manufacturing business by and large operates at mid-teen, and they are pretty safe there. Quarter to quarter, there could be some variation depending on the state of completion of the jobs, but safe to presume that they'll all be operating around 15% margin levels, and the volume of that business is also not very large to move the needle overall. What is going to move the needle overall is how we perform on our infrastructure segment and how we perform on hydrocarbon segment. Let me first take the hydrocarbon segment, which is in the news for all the large orders that it has won. Its execution has been doing pretty well. We have grown on revenues as well, and the margins between 9 and 9.5% looks quite stable on hydrocarbon business. And since most of these orders are obtained post COVID, we didn't have the constraint that we are having on the infrastructure book, which lot of which was won in the 1920 and 2021 period. So the issue that we need to tackle for improvement in the overall margin of the company is that of infrastructure business. Infrastructure business, as you know, are done executed over a 3 or a 4 year period depending on the type of contracts. So the impact, whether it is positive or negative, takes these 12, 15 quarters for it to actually play out. Now, very surprisingly, you would have noticed in the year 2021 and a bit of 21-22, we continue to report healthy margins in infrastructure sector, almost sort of mocking the cost inflation. But we should realize that those are contracts that are executed, which are obtained of the period 18-19 and 17-18. So they obviously had the advantage of protected margins. The contracts that we are currently executing will hopefully near completion, especially the legacy contracts that we are talking about. By the time majority of that will get executed by 1 year from now, but the tail will, the impact creating tail will be visible in maybe a bit in Q3 and a bit in Q4, which is the reason why I've been maintaining that the margins would be soft in the first half of the year. It will be progressively improve in the third quarter and the fourth quarter. And 24-25, you will see us return to more normalized levels of margin. Even between quarter to quarter, even though we are not a quarter to quarter company, the infrastructure segment reported 5% margin, 5.1% margin in quarter one. We are reporting 5.4% in quarter two. I expect this to keep migrating upwards to its potential of 7 over time. So, to that extent, the overall margins of our manufacturing and services piece, which is at 7.4% today, it was same as quarter one margin. The guidance was that it will move up to 9% from the 8.6 we reported last year. The effort between quarter three and quarter four is to get this 7.4 up as much as we can. Our assessment tells us, looking at the way projects are positioned for execution, that we should be landing up at the end of the year anywhere between the margins we reported last year and the goal that we have set for ourselves as 9%. So it could be anywhere between 50% and 8.5 to 9%. And what the market is reading as re-rating downwards of the guidance is, market went by our target of what we wanted to achieve as 9%. And when we say 8.5 to 9%, they do look at it as a downward correction. But I just want to elaborate and clarify to you that we never said 9%. We always said that we would like to move up from 8.6 to 9%, which is working our way up for about 40 basis points. We are still saying the same thing, except we are saying that it could be anywhere between 8.5 and 9, and not at the higher end of the band. But who knows? Next 6 months are good execution period, because there's other than some global interference like war and pandemic and stuff like that, we do think that this is a good period to execute and move ahead. We do believe that we will outperform our 12 to 15% revenue guidance, like the way we will outperform the order inflow guidance. Margins is a function of cost and various reimbursements of the claims, etc. So we'll wait and watch. But our effort would be to keep pushing towards our goal.
You mentioned the wars. Of course, the Israel-Hamas conflict is playing out, and we really don't know how that will pan out. I mean, we can't really fathom the human aspect of it. But from the business point of view, do you expect any impact on your business and operations? Because I mean, Saudi is almost what, 80% of your international order book now. So, how are you viewing it, and is it becoming challenging for companies with international presence, given what the kind of geopolitical tensions we have been seeing in the last few years?
See, Saudi has been a good market for us because we are benefiting from their Vision 2030. I think the kingdom today wants to reposition Saudi from just being an oil and gas exporter to a much larger economic play. And they're building not only the energy part of the business, they're building several other parts of the business, and we are benefiting from all of those. We are a large participant in their energy transition. They're investing a lot in solar energy. They are recreating cities and building new ones. We are participating in those. They're trying to provide rail network, and they're always connected well by roads, but they never had a great rail network. So we're trying to benefit from that. They're making habitation more sustainable. For example, water recycling, etc. We are again benefiting from that. So Saudi has become a wider play like India is for us. We participate in several areas. Fortunately for us, in the strife that Israel is currently caught up with, the Saudis' participation at the ground level is on a very, very low key. Geopolitically, I wouldn't know as to how the palace and the kingdom is thinking about this. But the fact of the matter, looking at the things on the ground, seems to suggest that it is fairly secure in terms of its project execution time schedules. And we do believe that as we speak now, the war is already 2 weeks old. We have not seen any interruption. We're allowed to continue to work. And I think that way we are rather contained adequately, safely within Saudi Arabia. And we do believe Saudi's slant towards participation in all this strife will be low key, because I think the balance that they have to strike between the political stance and economic development seems to be tilting in favor of economic development now.
Mr. Raman, stepping a little away from infrastructure, your services business, primarily the IT and services business, you mentioned in the conference call yesterday that it is experiencing, much like its competitors, a little bit of headwinds there, and that you had to work on managing the staff in that business. Help me understand how the environment is looking going ahead, and when you're talking about managing staff, what kind of measures are you taking? Are you going slow on hiring? How does it work going ahead?
Actually, the IT clients and the engineering technology clients are very different species. The technology clients are actually proceeding with their program, which improves the functionality of their end products, whatever that be, or their processes. So, to that extent, I think to stay ahead of technology for their own competitiveness becomes a compelling reason for them to continue to outsource engineering technology work. So I do think that L&T Technology Services, which is more into the embedded engineering bit, is in a little better place comparatively speaking in terms of facing the next 6 to 12 months as compared to commercial IT. Commercial IT has fair bit of discretionary spend. A lot of money was spent in migrating the data from on-premises servers to cloud, etc. We did benefit from that move and bagged fair bit of orders as businesses, particularly post-pandemic, started resorting more and more to internet-based transactions. So that phase, I think, will slow down a bit now because people would possibly like to reassess as to how that spend that they have done on that area is going to pay out for them. But insofar as regulatory compliances, insofar as financial services, insofar as essential lights on services, I think we'll continue to see traction. Except that, given the overall slowdown in the IT spend, the competitive intensity has increased. The clients are also obviously will take advantage of this situation and putting out projects more and more based on outcome, in the sense that it is not going to be hiring for time and material spent, but it is also going to be part of the compensation will come out of the outcome we achieve. If there is a productivity improvement IT project that we are doing, we have to establish productivity and share the upside with the customer. Now, this is a trend globally, and all IT companies will have to reposition their business models, and we are doing that as well. So, in a way, you can call that as an investment led IT growth. This transition between just mass hiring for time and material to outcome based is a is an inflection point in the industry, and I think that's what the industry is going through. We still have grown. We've grown by 7% for the quarter, 10% for the year on year basis. But this is not the same as 15 and 20% growth levels that we saw 2, 3 quarters before. We think it will settle down because I think we are inextricably connected to technology in the way we work, we conduct our business, etc. So I think slowly, I think the discretionary part will become compulsory part of existence, business existence. We're already scaled up ourselves. We are almost the fifth in that list of IT companies serving out of India. We'll continue to work on our competency. When we talk about staffing, I think it is just not the question of how much of compensation we need to pay to people. We need to have people of the right skill set. As world is transiting towards AI and all the related technological developments, we need to reskill our people. People who wrote the normal COBOL code may not be useful today because of the low code, no code evolution that has happened. So the investment that we need to make in talent, which will enable the industry to help our clients move to the next 5 years, 10 years profitably, is what the industry is talking about. We are also talking about in terms of augmenting the resources of the right kind. We also have to balance between the pyramid because we need to have a good amount of lower band of people who will cost less but who will do the grunt work within this space, and then we'll have to build business leadership and technology leadership on top of that.
Mr. Raman, of course, this would be a long-term exercise that you will have to probably take global cues on and then move ahead. But closer home, your development projects, of course, we are talking about Nabha Power Plant and Hyderabad Metro. You've been very diligently working on making both projects more lucrative, and of course, divestment is a theme playing out there as well. Interestingly enough, for the Hyderabad Metro, I see that the ridership has gone up significantly. And the other interesting development is that you obviously have a soft loan available now from the Andhra government, which you have been drawing as and when scheduled. Help me understand, how far are we from going forward with divestment of Nabha and Hyderabad Metro?
I think the good news is quarter on quarter we are improving the profile of the project, improving the economic prospects of the project, etc. The effort, as we had spoken earlier, would be to receive the full tranche of 3,000 crores from the government of Telangana. It's a no interest, long duration loan, and use that to reduce the commercial borrowings that we have had to put up the project. It was also important for us to actually start selling land parcels, and we made a successful start in the quarter that just ended by selling almost 17 acres of the land that was attached to the metro project. It did take long time to get the consent of the government and the authorities to be able to do that. And now that we have done with one parcel, we should continue to look at other alternate parcels and make sure that the land value is unlocked. The value that we will realize by selling of this land, apart from it generating some profits from time to time, will also help us unlock value, which can be used to pay the debt down. The minute the ridership, which has been improving very steadily month on month, we are today on every working day crossing more than 5 lakh people traveling. And 1 year before, this number was 3.5, 3.8. So there has been a tremendous improvement on that. And we hope that as more and more organizations ask people to report back to work, this will increase, because Hyderabad does have a fair share of IT population, and that's a catchment area for us as well. And thirdly, Hyderabad, the Telangana government has come up with a proposal for expanding the railroad network. Obviously, we are not going to be a sponsor of that project, but we will get an opportunity to build it if we are competitive, and that will help to complete the feeder networks for this project as well. So this project will benefit from that larger network development. So consequently, sale of land, using the proceeds to repay debt, increasing ridership, getting the soft loan and repaying debt, all of that will enable the project profile to significantly improve from where it is today. In 2 years, possibly 2.5 years from now, we should be able to proposition this project as an attractive investment to funds, maybe sovereign wealth funds, maybe PE funds, maybe some other REIT investors. We'll have to figure out who at that point in time would be the interested suitors. But we are definitely moving towards that. Once we make the project healthy, we are confident that we should be able to find attractive investors. Also, we are still operating at the first tariff that was fixed. The tariff fixation committee has recommended that the project is due for a revision. So maybe we will identify the right time window for us to announce the revision as well. So that will also add to the viability of the project significantly.
So looks like all the measures that you have taken, it's helping you see a better timeline. So that best of luck for that. Before we wrap up, Mr. Raman, I'm going to squeeze in one last question, which is of interest to me personally and to many, many Mumbai residents. I mean, we have had a terrible time with pollution in the city, and I mean, it has been a problem in other bigger cities as well in the country. One of the things which is emerging is the authorities are saying that a lot of the pollution in Mumbai particularly may be coming from construction, and we do have a large amount of infrastructure projects going on across the city, whether it's the roads or highways or metro. And you, of course, are executing a lot of these projects. So, two parts of this question. One, what is your assessment of the situation? How much of it is actually coming from infrastructure, and do you think there could be hiccups for you if the government decides to take some measures to curb that? And B, on your part as L&T, what measures are you taking to ensure that at least you are not contributing to the pollution?
Actually, we have been working with government for several months now on pro bono basis as to how to improve the pollution level and the disruption that construction activity causes to the city of Mumbai. Because so much of our contracts are under execution, so we do believe that we are an important stakeholder in this. As a company, even before the smog became an issue of debate and inviting attention of central government and local authorities, we have been in our sites practicing several processes to make it easy for our own workmen working there. Let me even make it, a very need-based effort that we had already done, and we keep doing it in our sites. We use water sprinklers quite regularly. We use wet cloths to absorb the dust particle. We use barricades, and you will find out, as you drive around Mumbai, you will find out the quality difference between the barricades that we use for our sites versus what somebody else uses. All of this costs extra money, and the contract does not provide for it. It's a question of, we believe that we have to provide the right environment for workers to do, and the cost that we incur will get repaid by the improved productivity and lesser fatality and better safety. That's the belief with which we work. Many of the things that the government has come out with as an announcement are nothing but practices that L&T is following. And we have also shared this with the government, saying that these are the things that should be made mandatory for all the contractors who work in the city of Mumbai. We do believe half of the problem lies with the construction, and half of it lies with the pollution caused by emissions of other kind. Look at the traffic congestion and look at the state of roads. The state of roads adds to more time, more hours on the road, and more hours on the road means more fuel being burnt and pollution being created. So construction seems to be an easy target because it's most visible, but equal measure, the vehicle pollution is also something that we need to bother about. Third, I think in the quest for real estate development, I think the authorities that approve all this are in some sense changing the tree line of Mumbai. The greenery is shifting. And even though, for example, a company like us, almost 2 million saplings, we have planted in half year ended 30th September alone, because we are conscious of the fact that we are destroying so much of greenery to build all the infrastructure. But this is not a uniform practice in the industry. And also the authorities that be, when they give sanctions for projects, especially the residential, commercial, real estate, etc., the amount of trees that get felled and not gets adequately replaced is something that the authorities will also have to think. There is something like capacity for every city. Mumbai seems to be like a sponge. It absorbs more and more and more, and it's been going on for the last 50 years. Now, there comes a time where city has to expand to other corners, for which jobs have to move there. So I guess it's a larger issue, Rachita, that the city planners will have to take into account. Mumbai cannot be the panacea of every hungry stomach. We have to figure out a way to deal with this better. But I can only assure you that what the government is putting out as SOPs are what we have shared with the government as our practices.
Fair enough, and very rightly put. I mean, the pressure on Mumbai is way too much, and let's just hope that it doesn't get worse around Diwali. On that note, wish you a very happy Diwali, and we will keep in touch, and of course, on time speak to you whenever there is any relevant information. Thank you so much for talking to us, and have a good day.
Thank you so much, and Diwali greetings to all of you as well.